Welcome, welcome, welcome. I'm Brian Love, head of Depository Search for banks and credit unions here at the Travillian Group. Thank you, viewers, for tuning in live today. I am broadcasting from just outside a sweltering hot, somewhat rainy Philadelphia day, and I'm here at Travillian's worldwide headquarters. We've got a great event in store for you. Before we get started, just a little bit about myself and about the Travillian Group. So again, I'm Brian Love. I specifically cover community banks, generally under 20 billion in assets, on engagements centered around board and leadership search, succession planning, and talent advisory. Travillian's been executing these types of engagements since 1998, and we've got a huge, deep network, which includes the bank executives and also some of their key advisors in the space. In today's webinar titled Depository Investment Bankers Unplugged, we are joined by three, you guessed it, investment bankers who focus on financial institutions within the Northeast and Mid-Atlantic regions. We're hoping for a fun and informative conversation as we discuss their perspective of the banking industry and their outlook on the future. I'll first introduce my co-moderator and colleague, Brett Rabatin. Brett, tell us a little bit about your background and also love to hear a quick take on the industry.
Yeah, thanks, Brian. So hi, everyone. I'm Brett Rabatin, head of bank strategy at Travillian. Previously, I was a sell-side research analyst for 20 years at several firms, most recently Piper Jaffray. And I joined Travillian a few months ago to help banks with overall strategy, capital analysis, efficiency improvement, and performance metrics. And my quick take on the environment is, banks are trading close to book value because of credit and revenue headwinds. And while this has been a tough year, banks are up 8% the last week. And I've heard from several bankers that deferrals are down, some having an up to 80% decline in early August from May, which gives me some hope that the credit environment from COVID impacted portfolios could actually be, or could be less than what the market's baking in. So today's guests are established investment bankers, and we're going to cover a lot of different topics. And I'll give our panelists a chance to introduce themselves first, but would also love to hear why you're passionate about community banks. So we'll go alphabetically. So first, Scott Clark.
Okay, well, thank you for the introduction. I'm Scott Clark with Piper Sandler. I'm a co-head of the financial services group here at Piper, and we're excited to be part of the event today. So thank you very much for having us, and we're looking forward to getting into the nuts and bolts of the community bank market, what we're seeing in terms of equity valuations, M&A activity, credit marks, CECL, all of the elements that I think a lot of the community banks out there are focused on, fintech, a lot of the different topics. So we're looking forward to today. Thank you for having us, and I'll pass it over to the next party.
All right, Dan Flaherty, you're next.
Thanks, Brett, and thanks to the entire staff of the Travillian Group for putting on this great event today. I appreciate the invitation. I'm a managing director at Janney Montgomery Scott, formerly with FIG Partners. We've completed our merger last year, and the reason I do what I do is, like anything in life, I love the people. I love the people that I work with at Janney. I love my clients, all the bankers on this call today. And I even like those attorneys. I even like those bank attorneys that we get to work with from time to time. So that's what keeps me going.
And last but not least, Frank Sorrentino.
Hi, everybody. First of all, thank you, Travillian Group. We really appreciate this. This is it's a great time to do it, post Q2 earnings, and a lot of interesting just data out there, although a lot of uncertainty. So excited to, we could probably talk for hours about various M&A topics. And I think it's interesting. Why do I do what I do? So, right now, maybe more than other times, I love the opportunity to sit with a company and sort of just, whiteboard out. As many of my clients will probably hear this and say, yeah, he's like a team member. And I grew up playing competitive sports. This is probably the closest thing to athletic competition, and just everything is a team game here. And so excited to just tackle challenges right now. And yeah, that's it.
Okay, great. Thanks. It's great to have you all here today. Let's dive right into M&A. So I've been hearing recently that banks are talking more about M&A possibilities in 2021. I personally think MOEs are going to be popular, valuations are going to be low, and the sizable premiums just aren't possible, which looks like the case, until the interest rate environment changes. But they can be tricky given social issues and different cultures at similar size institutions. Frank, let's start with you. What's a good roadmap for thinking about MOEs, and what might look like a successful deal in the MOE world?
Yeah, this is going to be a hot topic, and look, we've actually seen an MOE now in the post-COVID world. Bridge Bancorp Dime, that was about a month ago. I'd say a couple things. MOEs are very complicated. It does start with the social aspect, and I think being able to clearly communicate to the external constituencies, whether that's Wall Street or your customers, what does the C-suite look like? And with a lot of these MOEs, there's a lot of question marks around what is the management team going to do, who's really running. And I think that needs to be clearly communicated. From the financial perspective, just like any other bank M&A deal, it's got to fit into the right, earn back thresholds and earnings per share numbers and IRRs. I think particularly around MOEs, what is important is, each company, because it's typically an all stock deal, each company really needs to be thinking about earnings per share accretion. And, look, my personal view on this is a MOE there's a lot of execution risk. It's a bet the bank kind of undertaking, and you've got to be properly compensated with that from an economic perspective. That's just a fancy way to say, I think you need double-digit minimum EPS accretion. And, if I think about the bridge deal, one of the criticisms from the public market was bridge, was only in the 7 to 10% EPS accretion for the amount of execution risk that they were undertaking. Was that really enough? And I think that's a critical component. And most of the other MOEs that we've seen, all obviously pre-COVID, have had some substantial EPS accretion numbers. So that's the other piece. And I'd tell you this, there's a lot of chatter around MOEs. There was a lot leading up to COVID. I do think there's going to be a lot of activity going forward, particularly if the bank stocks stay as challenged as they currently are. I have a unique view on MOEs, just generally speaking. If you look at the ones that I think have been successful, and you can measure success by profitability 2 years out after the transaction or the shareholder return metrics, I actually think the better deals have been the complementary ones, not necessarily ones where there's a ton of branch overlap or just business line overlap. And I think that's an interesting template, particularly as we get into the post-COVID world, branch light. And I think folks should be thinking about the complementary deals. And if you have a lot of overlap, do you have the culture aspects knocked down? Do you have the employees retained? Because what we see is sometimes you can get cost saves out with a lot of overlap, but there's a revenue drop off.
Maybe a follow-up to that question, Frank, just thinking about, you mentioned the Dime Bridge deal, and you look at those two balance sheets and you're combining Dime's more thrift-like balance sheet and Bridge's more commercial balance sheet. I mean, I look at that and I think, geez, if I'm a Bridge shareholder, I'm a little bit disappointed because now I have a lower level of core funding pro forma than I did before. I mean, how do you combine two banks where one bank is more core funded than the other one?
Yeah, it's tough. I mean, I think, you could take one view and say, whether the balance sheet, the revenue quality is lower, Bridge pro forma versus Bridge pre. On the other aspect, I do think the investment community, generally speaking, and no offense if there's any hedge fund managers on here, but there tends to be a little too much focus on net interest margin. I think people sometimes miss, at the end of the day, what really builds long-term value is book value, and what drives book value? Well, ROE. And is the bottom line company in the Bridge Dime case via cost savings, which I think there's going to be a lot of there, does that ultimately offset any dilution from the net interest margin changing? So, there's a lot of aspects, just like any other transaction. And I do think, particularly for companies in that size range, there's a scale aspect particularly in a competitive market. And so that's a pro to it. And also looking at ultimately what's the bottom line impact, and operating, expense synergies in a lot of ways are low-hanging, fruit with less execution risk.
Thanks, Frank.
Thanks.
Obviously, Scott, we can get your take on MOEs, but just moving things along to another question. It's kind of a two-parter for you, Scott. So there's been 75 deals in the Mid-Atlantic versus 35 in the Northeast since January of 2017. Do you think deals in the Northeast increase on a relative basis going forward? And can you give any examples of institutions that have paired up that are in better shape now than the ones that have stayed independent?
Yeah, well, all good questions. The Bridge Dime deal, Piper was fortunate. We worked on the bridge side of that. Kevin O'Connor is clearly one of the best CEOs in the United States, and he's done a magnificent job with Bridge. And I think that transaction, clearly makes both companies better and adds to and increases the scale and provides more assets for management teams that are well regarded. And so, these MOEs, we were fortunate earlier in the year. We did the largest MOE of the year was South State, Center State, I think, which closed not too long ago. And South State and Center State were also two of the best banks in the country, run incredibly well. Robert Hill running one, John Corbett running the other. They came together, two incredibly strong companies making an even stronger company together. And, the math is, as Frank just commented, the math is relatively straightforward. You're in an environment where rates are lower for longer. Expenses become more relevant. It's a tough revenue environment, so expenses become more relevant. So if you can put together franchises that are strong, and these MOEs, they're being put together many times by strong companies on both sides. They have options. They have different things they could do. They could stay standalone, but they perceive that together that they're going to be stronger, they're going to be better, and they're going to provide more value over time. And I think those are great examples. The Northeast, the backdrop of the demographics, a rising tide raises all boats, and the demographic backdrop and some of the impacts of the health situation in some of the Northeast markets. It's going to be interesting. You got lower for longer. You got slower growth. Expenses are clearly going to be a priority. Transactions will continue. The trend of MOEs, the trend of bank merger activity, that's not going anywhere. That's going to be a trend that's going to stick with us for a long, long time in all across the country. And that's going to be something we're all going to be living with for quite some time.
Thanks for that, Scott. And by the way, just to interject, Center State, we did a lot of work with Center State on the recruitment side. World-class organization.
You did a good job.
Oh, thank you. I'm not taking any credit for anything here, but go ahead, Brett. I think you're next up here with a question for Dan.
Yeah, Dan, I was going to ask you, is now a good time to consider buying core deposit franchises, considering rates are so low, and kind of what pricing makes sense for changeable book core deposit premiums at this point?
Yeah, a good question. I mean, I think core deposits are always valuable regardless of the environment. I think the true asset of a community bank really is its deposit base, the stickiness of it, the low cost of it. So certainly with rates being lower, core deposits are not valued as highly as they were in the past. I think that the best price to pay for core deposits is the price that gets you the deal. Right? I think you got to win it. You got to improve your deposit portfolio. And I think if you can acquire some low cost deposits now and maybe not have to pay up for them, that was really going to suit your balance sheet going forward. So I think now would be a good time to pick them up when maybe they're not as expensive as they've been in the past.
Yeah, good point. Frank, a question for you. So, as a former sell-side analyst, I know that many banks kind of have a targeted list of names they always want to be in front of in case the timing is ever right. How do buyers get their desired targets to sell to them?
They hire folks like us, right? No, just kidding. Only half kidding. Look, I think most M&A, and particularly when you're talking about negotiated MOE style transactions, it's typically a CEO to CEO, relationship, a courtship that generally, there's many times where CEOs are meeting together, grabbing lunch for every 6 months for years before anything actually occurs. That's a very important aspect to it. I think right now, and let's go under the assumption that anybody that's been thinking about M&A, you've probably, whether you're on the sell side or acquisition side, you've been out consistently talking to your 5 or 10 buyers, sellers, targets, whatever have you. I think right now it's an interesting time as conversations sort of restart, which I think they are right now. One of the key things, if you're the buyer, I think you've got to be able to demonstrate 2 different things. One, the seller probably has a price in their head that you may not be able to necessarily get to right now. You need to rationally explain why. And a lot of this comes down to merger modeling, right? Where, we're so focused on tangible book value earn back, and a lot of that has to do with what kind of credit mark we're putting on a portfolio. So I think being honest upfront with, hey, look, here's how we're thinking about this from economic perspective, and here's the constraints we have, and here's what we can pay you. But if, these assumptions are changed and we get comfortable, maybe we can pay you, X. That is one other piece. I think today too, particularly with where bank stocks are, I think the buyers have to demonstrate that it's not just the headline. I still think we're going to see a lot of stock deals, although I do think we're going to see more cash deals, generally speaking, than where we previously have. The stock component, if you were to go back and look at the M&A deals, the stock M&A deals done in the 2008 to 2012 timeframe, and if you held on to the buyer's currency, the value creation on the upswing, particularly in the 2015, 2016, 2017 timeframe, was substantial. As opposed to if you took a stock in 2018 and that was the peak. Bank stocks peaked June of 2018. And so there's a long-term view that the buyers should be sharing and saying, hey, look, here's how our stock performed the last cycle. We think we're really undervalued right now as a combined company. Here's the kind of value we think we can build over time via dividends and just stock prices coming up.
Yeah, no, that's a good point, Frank. But it's always hard to get.
It's tough.
Sometimes these boards to understand that they're besides selling, they're also buying. So it's tough to get them to think about exit versus entry, so to speak. Hey, Scott, absent M&A, what are your thoughts on eventual buybacks as a use of capital? So I've calculated that the IRR is better than making loans at this point, but I also feel like investors are not necessarily excited about management, financially engineering EPS, but rather, using capital to improve the value of the franchise.
Yeah, well, share repurchases should be done when the bank management team believes they have excess capital and believe their stock is trading below intrinsic value. And in general, it's hard to get that perfectly right. So having done this for 20 years, there are plenty of examples of banks, buying their stocks in 2005, 2006, and then those stocks falling. So it's challenging to get those 2 calculations right. When do I actually have excess capital, and when is my stock actually trading below intrinsic value? And these last couple of years have actually been an example of that. If the stocks have been falling, and many folks were repurchasing shares last year, it's with hindsight, whether that was a smart thing to do. Now, what I would say is, when folks are considering an acquisition, it's very useful to look at, would you rather buy that company you're considering an acquisition or repurchase your own shares? And very often repurchasing your own shares may actually be a better alternative. You're not going to hear that sometimes from the investment bankers, perhaps, because there's generally, not many fees involved in a share repurchase, but it's an assessment that you should make. It's a critical assessment. Now, right now, the regulatory environment is challenging as it relates to share repurchases. The larger banks, as we all know, are basically on the sidelines. The dividends are under pressure from a regulatory point of view. But many of the community banks, share repurchases may well make sense. And it's when you're trading at a discount to tangible book, when you're trading at very low multiples on earnings, it's worth considering. Now, everybody, obviously, we're in a wave of capital raises, preferred stock, subordinated debt, etc. I believe just this week alone, we're in the market with 7 capital raises for 7 different banks just this week. So nationwide, of course, but still 7. So, folks are raising capital in some cases as insurance. So if you're raising capital as insurance, then you're not definitely using that capital to repurchase shares. In other words, you're hoarding your capital for a period of time. But share repurchases are difficult to get right. They can add real value over a long period of time. They need to be considered. I noticed Berkshire Hathaway repurchased some shares, which he almost never does in the last quarter. When Warren Buffett's doing something, it's generally worth considering yourself, So share repurchases are definitely worth investigating based on where banks are trading currently.
Great, thanks, Scott. That's helpful.
And we'll probably get back to capital a little later here, but I appreciate that thought, Scott. Dan, to kind of end our M&A topic and move forward with another one, I wanted to first ask you, size and scale matter with a need to be more efficient and allocate tech spending over a bigger revenue base. What do you think the right percentage should be for expense savings for a deal to be a good one? And has that number increased in this environment?
Yeah, that's a good question. I think it depends on the type of deals too. If you have a kind of a pure acquisition, pure sale, you want that number to be higher, in 40 or above. Certainly, if it's a strategic acquisition or out of market, that number is not going to be as high. I mean, you have to, as an acquirer, you have to balance a realistic number that you're going to, announce to the public, a number that you can achieve, and a number that you can outperform, and a number that is believable by the investment community. If you came out and said, I can get 70% cost saves, that's not a very credible assumption to put out to the market. I think you're going to have a lot of doubters on your deal. So I think the appropriate level is to, a level that is achievable, but yet can really maximize synergies. And I think depending on the type of deal, it's probably somewhere between 30 and 45%.
Okay, thank you, Dan. I'm going to move forward to another category, and this one is branches. So we've seen some bigger community banks like Investors Bank in New York and New Jersey. They announced maybe a couple weeks ago that there's going to be a consolidation of their branches. Also, FISI in New York, and there's a few others out there. They're going to be shrinking this branch network to create efficiencies. So a lot of these plans were in the works before COVID hit. But how will this positively or negatively affect their businesses? Because you can kind of see the pros and cons. Scott, we'll go to you first on this one, and maybe if we have time, we'll get some other thoughts.
Well, the health situation has led, of course, to less utilization of branches, which has led to many folks either temporarily closing branches or permanently closing branches. And one of the trends of the second quarter was, and Brett has perfectly positioned to talk about this. One of the trends was the long-term revenue picture looked weaker, and therefore many banks have announced cost savings initiatives, and Bank United had a terrific result in terms of the cost savings initiatives that they're running and the progress they're making. And of course, the stock responded very positively. Now the stock's down, but it responded very positively to that cost savings initiative. So the branch footprint is something that all banks are looking at. Of course, it's driven in part by fintech competition and large bank competition, and the large banks, as you say, normalizing their branch networks. And community banks, arguably this is an opportunity to rationalize some branch networks. Of course, some customers still like to open accounts in branches. I don't know if that's true today, but certainly over time that's been true. So look, a lot of companies they're reducing their branch footprint. Deposits per branch has been important for a long time. It's likely to become more important. In any business, when there are more channels to get to the customer. So take the newspaper business. There are more channels to get news to customers. You can get news online, you can get news through Twitter, you can get news through. So when there are more channels, every channel, the historical channel generally becomes less valuable. So the newspaper becomes less valuable because there are other channels to get news. Well, the branch becomes less valuable because people prefer to use their phone. So it's a repeat of what's happened in other industries, and this has accelerated it. The health situation's accelerated it. The lower for longer's probably accelerated it. Arguably MOEs will accelerate it, but it appears we're going to have fewer branches.
Yeah, Scott, I think the old math was you had to have 20 million in a branch for it to be break even, and I mean now I think you want to have 50 or more just to kind of keep that branch on the potential slate. Dan, I'm curious, how can the smaller players in these same markets capitalize on these branch closures of maybe some regional or larger regional type players?
Yeah, that's a great point. I think we've definitely seen some of the larger players come out, and this is an opportunity for smaller banks to stay in the market. I think part of the movement to close branches in these markets is social. Banks have always been hesitant to close branches because they don't want to be seen as leaving the community or the villain in the community. And the pandemic has really kind of given banks an out to do that, so it's caused some of this to happen. But I think just reiterating your commitment to the community and finding a way to service that community through this pandemic vis-a-vis PPP. We've seen that. It's been a great opportunity for small community banks to pick up clients and just maintaining your commitment. Just like community banks have always done for hundreds of years now. I think they just need to continue to be front and center of the community, and when someone else leaves, be ready to step in.
That's a good point on the community. Frank, I'm curious on your thoughts. While we haven't seen more branch closure announcements yet, is it a function of, these banks want to measure twice and cut once, or do CEOs kind of seem afraid to lose their castle, so to speak, in your view?
No, I think we're going to see a lot more. I think a lot of executive teams have had their head down really since March, 15th, dealing with just COVID operational issues, PPP, and now there's maybe another, second round coming. I don't think the executive teams, many of them have not had a chance to just sit back and say, okay, let's think, strategically. And, there are a number of folks, and I suspect virtually everyone who has announced a branch closure or consolidation has probably been thinking about this for some time. And I think it's just a matter of, it's not if, it's just when. And I would not be surprised to see in the back half of 2020 here some branch acquisitions, divestitures. And I think, it's interesting to go to your question. for the smaller banks, and let's say the banks under the $5 billion level, you could be in let's maybe say a lower growth market area where the larger banks may be exiting via closures or just selling off branches. Those branches might be very valuable to you, even though they're not as valuable to a larger bank. You can probably operate them at a lower branch size. Presumably there's going to be overlap, so you can get cost savings out of that. And so I also go back to the question you asked around, is now a good time to buy core deposits? I think the answer is absolutely yes. It's amazing how in short order, 6 to 12, months ago, everybody was looking for the low loan to deposit bank, and core deposits were coveted, and everybody's sort of forgotten that. And I think it's also interesting in that we just went through a rate rise cycle for the better part of 3 years, and you've gotten to see through that which companies had quality core deposit franchises. So I think this is the exact right time to be, if you're able to play offense right now, look at buying core deposits.
Good points, Frank.
Yeah, thank you, Frank. Kind of to end this topic of branches, I'll just go back to you, Dan. Where do you think branch closure cost savings can be, best utilized?
In net income, increase EPS, right? I had a guy ask me if changing his ticker would increase his stock price the other day. I said no, but increasing your earnings would. And it wasn't really the most political answer, but it was the truth. So I think getting them to the bottom line is the best, or stuffing them in provision right now. I mean, banks aren't really trading off earnings. So if you can find some cost saves, or you can find some additional revenue, putting them aside, a lot of people have done that with their PPP fee income that's coming in. They're going to throw that in the provision. I think that's a good place to put it right now. It's a good spot.
Yeah, and obviously digital banking adoption has been huge, this year. So I would probably think that's a good idea to, invest that in technology as well. We'll change the subject. Now, you mentioned PPP, Dan. I appreciate you bringing it up. I'll just set the table here. I'm not asking you guys to give me your forgiveness thoughts. That's kind of a little bit nebulous. It is a hot topic, though. A lot of the people I polled before this webinar, CEOs, CFOs, wanted you guys to talk a little bit about PPP. So, Scott, I'll go to you first. And, there's been some interesting, people buying PPP portfolios, selling PPP portfolios, et cetera. What is something that you might find useful for our audience here to hear about PPP? You can take it any direction you'd like.
Well, I think one of the key items that you haven't had a lot of discussion of is the franchise value that has been created by community banks who have been able to transfer customers from larger banks by being agile and responsive around PPP requests. So the volume, and of course banks, don't get congratulated for the incredibly good work that was done by banks as part of the PPP program. It required a lot of late nights, a lot of focus, a lot of effort. It was difficult. The rules were changing. But the upside is that for a lot of community banks, they were able to move customers from competitors that would have taken, that they may never have been able to move, without some event like this. So they were, and that creates incredible potential long-term customer relationships for the community banks across the country. So I think it was a unique. Now, of course, you have the margin pressure. You have the need to work out how you're going to fund the assets, which most people did through the government program too. You got to be thoughtful about the runoff of these loans, hopefully over time. But it was for a bank that might be 400 million in assets that's now 550. That's a very significant change. Or a bank that was $1 billion assets that's now $1.3 billion. That's a very significant change and enables them to utilize their non-interest expense base across a bigger footprint. So I think you haven't seen enough commentary about that. There's been some real franchise value created.
And that's a good point, Scott. When you're with those commercial clients in their hour of need, the loyalty there is forever for banking those. That's a good point. Dan, I'll go to you. Another question about PPP, and Frank, we'll have a question for you just after. I did mention banks like Bryn Mawr Trust. They sold their PPP portfolio to the Loan Source. I think a couple of weeks ago we read that story, and a few others smattering of news around that. What are your opinions on being on either side of that transaction?
Yeah, good question. That seems to be kind of a new trend evolving, the sale of these PPP loans. I mean, on one hand, I get it. It's a very uncertain program. You know, maybe what accounting treatment or regulatory treatment you're going to have, or the forgiveness around it going forward. So saving the opportunity cost, booking the gain and selling it, I get that. I totally get that. That makes financial sense. That makes bottom line sense. You know, what does that do to Scott's point about building franchise value and servicing these clients? You know, if you've just been there in their hour of need and then they get a notice in the mail that you sold their loan, how does that doesn't translate to the bottom line, but how does that translate to your customer service and your franchise value and what you created there? So it'll be really interesting to see how banks make that decision. Bryn Mawr Trust is multi-billions of dollars. But if you're a $300 million bank and you really use this to pick up some really good customers, that's probably a much tougher decision. So it's a really interesting dilemma. I mean, I think there's no broad answer for every bank. You know, it's case by case and what makes sense for you and where you are and your other strategic initiatives. But, you know, when the program came out, someone asked me about selling their PPP loans, and I hadn't even thought about it. And I was like, you know, I guess you can. And now we're seeing it. I think we'll see more people do it, evaluate their options and they think it makes sense for them.
Thanks.
You know, it's pretty interesting with the PPP program. The balance sheets have ballooned up, and there's all this excess liquidity, and there hasn't been much core loan growth. Frank, what do you think banks should do with the excess capital liquidity? It's so hard with rates low and uncertainty around the timing of a reduction in liquidity. You know, how do you advise banks in terms of what they should do with that excess liquidity at this point?
Yeah, it's a very tricky thing. Virtually every bank this quarter had a pretty sharp uptick in non-interest bearing, and a lot of it was PPP. And I've asked the question I've talked to probably 20, 30 banks since second quarter numbers came out, and I've asked the question of everybody, and it seems that the industry generally doesn't know exactly how much of that is going to be temporary. And I think trying to monitor that's the key thing, because you don't want to go lend those funds out. And I know there's a lot of banks are probably jumping ahead a little bit. There's a lot of banks buying, sub debt and trying to extend, durations to offset net interest margin pressure. But you don't want to get caught in a liquidity mismatch right now just because you got, more liquidity at the moment, but a lot of that could be leaving. So I think number one is just understand, what do you think is temporary? What is going to be core? And then, look, I think generally speaking, 2020, and I think, Dan had said it before, there is less of a focus around earnings right now. There's so much noise and just P&Ls and ratios. I think this is the right time that if you got to run with a little bit more liquidity and you pull back on some growth, this is the right time. It's okay to sit and even just sit with excess capital. We are still in a very challenging and uncertain time. And I think you've got to have a plan for ultimately how do you deploy that excess liquidity, excess, capital. But it's not the worst thing in the world in the short term to just pause, fortress balance sheet, to steal a Jamie Dimon, quote, and really understand what do we have, and if we want to play offense, how can we play offense? And one thing I am starting to hear, not surprising, this happened in 2009, 10-ish, the larger banks are cutting lending teams, and there's talent on the street. I suspect that's going to continue to happen. If you've got more liquidity and it's going to stay, and you maybe need some more earning asset generation, putting aside M&A, I think there's certainly, that would be a very wise CapEx move, is to go maybe hire some talented, producers in whatever lines of business that you're currently, focused on, or new lines of business. I think there's a lot of folks that have their eyes on certain business lines, C&I business lines. This is the right time. 2020, in my view, it's a whiteboard is clear. And if you're going to be making moves to set yourself up for playing offense, this is the right time to go hire talent, buy out teams, lift outs, things like that.
That's great advice, Frank. I think banks can be on offense this year. We'll see how fast we get back to offense. You did mention fortress balance sheet, which kind of brings us to our next topic, which is credit quality. And, I personally, think 2020 is really kind of lost from an EPS perspective, especially. And, my view has been to grow your reserve as much as possible. And I did mention at the start of the call that loan deferrals seem to be abating. But we have heard from a few banks that 2Q was the peak of provisioning. I guess, do any of you guys have a view on that topic?
Brett,
Yeah,
I think if you're going to do provisioning, now's a good time to do it. I think people's stocks have been hit so hard. There's not going to be a reaction in the market, so now is the time to do it.
Frank, you had something you wanted to say there?
Yeah, I generally agree with that. Although the one maybe counter to that. And I'm like picking on the, hedge fund guys who I hope are not on this phone, because they're not going to like me saying this. But, I've heard a lot of conversations between the institutional investors talking to CEOs, CFOs, saying you need to pile in, ALLL, ACL, and you should just be reserving. And I find that a little bit of a self-serving comment. A lot of these folks, I think, want the banks to pile in so they can probably go buy the bank cheaper. And while in some cases it is, generally warranted to build up ACL, on the other hand, there's still a lot of unknown. And I actually think if you look at most banks, deferrals have come down pretty significantly. I mean, I think the average bank, at least in this market area, somewhere 50-60% of the original deferrals are coming back and now into performing status. And so if that continues, I think by and large, particularly the CECL banks, so generally everybody $5 billion and up, probably have adequate reserves to handle any future charge-offs. And even the smallest banks are, the ACL levels, when you strip out PPP, you're looking at 1.3, 1.4, 1.5%. I mean, that's a lot of cushion. And again, track record, tangible book value, you can't just throw the kitchen sink every quarter because you have uncertainty. And so I would push back a little bit from anybody pressuring folks to reserve too much. Certainly, if you sell the loans, different story, but I feel like you can't necessarily just throw the kitchen sink at it.
Interesting. So, Frank, you think the banks have the reserves they need today to mitigate or to essentially be able to charge through the potential defaults that they're going to have in the next year or two?
Well, this is probably going to come back to haunt me in a really bad way, but based on sort of what we know now, it seems that I think if you were going to try to forecast what the credit losses ultimately are going to be, if you go from deferral into what do we think goes into NPL, and when you have a NPL, depending on what we think price declines are, what is a real charge-off losses, I think there's a good argument to make that if you've got a reserve that's in and around 2% today, I think that's ultimately where we're going to see charge-offs. Some are going to be worse. Some are going to be underneath that. And there's a lot of banks that are pretty much there. I think most of the CECL filers are pretty much there. You've got the largest banks, even if you look at JP Morgan's, consumer bank, a commercial bank, they're well in above that. All the super and regional banks are above that pretty much. It's the smaller banks, the non-CECL banks, where I think there's a question mark there. do they have enough reserves? They may need a little bit more, but I don't think we're too far off from even just today taking a crystal ball saying, what do we think charge-offs are going to be?
Okay, interesting. Scott, I'm curious, what do you see the top performing banks doing to prepare for potential defaults? You know, I think banks should have a good special assets plan and a team ready and in place for when we do finally see some real charge-offs. What's your view?
Not sure if we lost Scott there, so perhaps Dan, you can take that question.
Yeah, that's a tough question, Brett. You know, you made Scott hang up, so that's a tough one to go my way. I don't know. The defaults it's really tough to handicap. I think we're in a kind of a waiting game. I hope Frank's prediction is correct and that we have enough reserves. I think the deferrals are getting better, but we won't really know till the end of the year. So it's hard. It's really hard to predict. And I feel for the people that are investing in community bank stocks because the information around all this is murky. I certainly hope the defaults are less than what we're predicting, but I don't know. I mean, the pandemic's still going. That's the big question. If you tell me the pandemic was going to end next week, I think I could give you an answer and say it's going to be quick, but the pandemic could go on for another year, and that could really extend things. So I think until we get clarity on the health issue, it's going to be really hard to predict the economic impact, although I can tell you that the longer the pandemic goes on, the worse the economic impact is going to be in my mind.
Yeah, and well, kind of on that point, I just wondered about this region that we're talking about, the Northeast, the Mid-Atlantic. It was pretty early, COVID hit this region. I'll kind of open it up to either one of you. Do you think this region bounces back quicker than the rest of the country? Because now the South is kind of going through the Southwest. What's your thought there?
I think it's going to be really dependent. Are you in a metro market or are you in a more suburban market? And, New York City, the metro market of New York City, I think is going to have challenges. There's already a lot of chatter that for the first time, probably in 20, 30 years, rents are coming down. Now they're at astronomical levels, so they're just going back to sort of very high levels, but nonetheless, they are coming down. There's a lot of questions now with work from home and people not needing to be in the Manhattan office, office areas. Does that bring down real estate prices? I suspect that we're going to have some pain there, and that may be true for other Northeast cities. On the flip side, though, it's fascinating. The home markets in New Jersey and Connecticut, Westchester, are as hot as they've ever been. And it's unbelievable how quickly things have changed there. And so if you're a community bank operating with primarily a suburban footprint and you're not dependent on a lot of multifamily lending in the metro markets, this actually, you can make a good argument that you're coming out of this better than you might be going in. Not all else being equal. There's a lot of other headwinds out there. And I think just more broadly, if you take the Northeast versus the rest of the country, what Scott had said earlier is very true. I think the demographic issues and the fiscal issues, I don't want to be political, but there's a reason why New York and Jersey, there's been population outflows. And I think this event is going to accelerate a lot of that, which is going to constrain the general economic growth there. You've already had a lot of people flooding into Pennsylvania, Florida. I think this event, that was a trend that was already going on. COVID has accelerated that. So I think that's just going to make it more challenging versus the rest of the U.S., which I think has better prospects for just economic growth.
Okay, great. That's good color, Frank. I think what this cycle has taught me anyway is that banks need to think about diversifying their business models, into more fee income sources to counter compressed margins, low asset yields, and declining loan demand. I'm curious, Scott, welcome back, by the way. I'm curious, kind of given the environment, the present seems like it might be a good time to reposition a business line, or, do you have clients looking to add anything organically or via acquisition to kind of help with the margin issue?
Well, the margin pressure in the second quarter, roughly 30 basis point decline for many folks in net interest margin, reignites, and then the lower for longer that we talked about earlier, reignites the discussion about non-interest income. You know, of course, Town Bank, which is about 12 billion in assets now in Virginia and the Mid-Atlantic, has a tremendous non-interest income business, non-interest income revenue, and it just creates a nice buffer, nice protection against the net interest margin challenges in the industry. The difficulty with it, of course, as we all know, is it takes time. It takes a lot of time to build these non-interest income business lines, and they've done many tens of insurance acquisitions, for example, over the years, and so it just takes a long time. Mortgage, of course, was an incredible highlight of the second quarter. The SBA business has been very strong for a lot of banks. The key to all those things, and of course where you folks at the Travillian Group become so important, the key to all those things is finding the right talent, finding folks with the right talent, and then having it be the right percentage of your overall balance sheet, your overall income, having the nice blend, the nice mix of what you're trying to put together. So it's critically important. There's a lot of debate over how large these non-interest income businesses need to be really profitable. And, there are examples of smaller community banks that have these business lines and they're actually not that profitable. And so then you get into this, you need some scale in some of these businesses, which makes it a challenge. But in short, the topic's stronger than it's been. We sold a company to Regions, a Centium Capital not long ago, and so there's a lot of banks looking at non-depository institutions, and I think they should be. I think that's a good idea. I think it's worth exploring. Also, the market, there was a period of time there where if you bought a bank, if you were a large bank and you bought a bank for a big premium, the market didn't like that. But they were open to you buying a specialty finance company or some other type of entity. They didn't seem to react with the same negativity as they did to some of these larger bank deals. So it's an option, particularly for the larger banks.
Well, Scott, thanks again. You mentioned another Travillian client, Town Bank. I worked with Bill Littrell and Kevin Fly on a few of their finance searches. But you also mentioned talent, and you're right. That is the Travillian Group's passion, is recruiting, top talent, helping banks, create strategy around succession, et cetera. So we're getting close to our 1 hour here, but I wanted to bring talent up as kind of a line of questioning. It's going to be a little bit of a lightning round. We're going to shift around, and I'll go to Dan, but I would like to hear from other folks on this question if you have a response. So considering talent and recruitment is our focus, do you think this crisis expedites retirements and succession planning? And, ultimately some roles might need to be rethought as well. What's your take on all of that, Dan?
Yeah, I mean, and I think talent and succession has always been a huge issue in the community bank industry, and recruiting talent and bringing more talent in has always been difficult. I think succession is critically important, not only to the management level, but also to the board level, to the employee level, to the customer level, and to the shareholder level. I think succession is something that is critically important to all community banks. And I think you're going to see, new positions focus on strategy. You're going to have people that are tasked with, following up on PPP. And those customers, you're going to have branch rationalization, you're going to have people like chief experience officer, things like that. So I think you're going to see a really big shift in human resources from all the way from the teller position to the C-suite.
I think technology and innovation is going to be sprinkled into everything as well, feeding into the core and delivering to your front, to your customers. Brett, I'll turn it over to you for our second question, unless anyone had anything else on talent.
I've got one maybe just quick thing. It's been interesting to see I'd call them some of the next generation challenger banks. You don't have that many of them in the U.S., although it seems that they are coming here. But even the younger, de novos, there's one bank in particular, Piermont Bank. It was a de novo charter last year. I think it's fascinating. They're ahead of the curve on just rethinking the whole loan origination and just underwriting process. And the whole question is, a traditional middle market C&I lender can do 20 million annually of loan volume. And the big question is, okay, if we know that, how can we change the back office technology and how many people it takes to underwrite that loan, to process it? And much easier done when you have a new technology system like a de novo. But I think there's going to be a lot of folks, again, to combat the net interest margin challenges right now, going back to the drawing board on, can we rethink processes and how does technology play? And can we be more efficient? Can we scale the business without just hiring? And that's with these, Cross River did what I think they were a top 10 PPP lender. I forget the number that they did, $4 billion, something like that, for a bank that's got assets, pre-PPP, it was like a $2 billion asset size bank. So I think there's a lot of these new age thinking that's going to be coming. It's a very healthy thing. But that we're at the very early stages of that. And I think that goes hand in hand with any talent plan, succession planning too.
I think it was 3.5% of all PPP loans done went through Cross River, which is a staggering stat. Yeah. Brett?
Yeah, great. So we're gonna wrap up here with one last question. We really want to help the banks out there, and so wanted to get from each of you, 2 sentences on just thoughts on how you would prosper through the downturn. Is there just one piece of advice that you would be giving banks these days? Scott, let's start with you, maybe.
Well, that's a tough question. I think in general, folks should be running the bank like they own 100% of it, and that they're planning to run it for at least 10 years. And so a lot of our advice at the moment is around how to do smart things that will ensure the longevity of the company which you're running and will improve the value and profitability of the company which you're running. So I think, if 2 sentences, run the company like you own 100% of it, and run it like you're planning to run it for at least 10 years, and good things tend to happen if you do those 2 things.
Okay, that's great. Dan, let's go to you.
Yeah, I would just echo those thoughts that say be resilient, weather the storm, and when this passes, be ready to go, because I think growth is going to come fast.
Yeah, I think growth will come back soon. Well, maybe not soon. It'll come back eventually. Frank, what about you?
If you haven't noticed, I can't do anything in 2 sentences, but I tell you, on the strategic side, I think you truly got to be honest and ask yourself, what is your differentiator, and are you a niche player? And that can mean a lot of different things, but if you're not, how do you get there? And then on the financial side, I'd say forget the noise with your stock price, focus on building book value over the long term, and good things will occur there. And that's ultimately the long-term value creation.
Okay, that's great advice. My toughest question of the event was limiting you guys to 2 sentences, I think. All right, thanks everyone so much for joining us today. Brian, I'll let you wrap up.
Yeah, just that wraps up our 1 hour that we had allotted. But thanks once again, Scott Clark from Piper Sandler, Dan Flaherty from Janney, Frank Sorrentino from Stephens. Also, I'll just end by saying we'd love to hear from any of the viewers out there, any feedback about this conversation. If you have any needs or thoughts on the industry for ideas on future webinars, reach out to Brett and I at www.travilliangroup.com. You can find us also on LinkedIn and on YouTube. So for Brett, myself, and the whole Travillian team, have a wonderful day. And thanks so much again, panelists.
Thank you.
Thank you, everybody.
Thanks.